right? Dave Ramsey always says, a family should always have at least 10 times the amount of their yearly income in term life insurance. All right, there's many reasons for that. One, and I know especially in Eastern North Carolina, it takes two incomes to run a household, right? I don't know the exact statistic. I just know where I grew up in Duplin County, North Carolina, there's not that many stay-at-home moms, right? And even if there is, heaven forbid that husband were to pass away, right? She's not going to want to go back to work. Okay, one of the reasons why I got into the insurance business is because my grandma was a stay-at-home mom for 35 years, 40 years. My granddaddy canceled his life insurance 3 months before he passed away. And then at 72, she had to go back and start working, right? Just to be able to stay in the house. Okay. So the term life insurance is mainly where we're going to get our bigger death benefits, which is really going to, cover the years where your children are trying to get through school, through college. And you've got a whole lot more expenses, through your working years. That's what's going to cover those years. And then a lot of times, as we get older and stuff, you really don't have that much expenses going on, that many expenses. That's whenever we're going to drop the face amount down a little bit, go into some whole life, and cover those final expenses. That way that financial burden isn't left on your family. Hope that makes sense.
Yeah, that's good. That's good. And I want to caveat that real quick, Jack, because you said something, and I want to let everybody, know out there that term, it's not necessarily going to expire after 30 years, but it's going to be level premium for 30 years. At year 31, it's unaffordable. I mean, it skyrockets. I mean, it's almost like you're paying in a month what you used to pay in a year. It's absurd, so we just it pretty much expires. It's kind of like the difference between work insurance and term insurance, like insurance that you own privately versus that group rate. I tell all my families this, Antonio: get as much as you possibly can through your employer. If you got 100,000, 150,000, I mean, see if you can double it, triple it, quadruple it. Get as much as you can. Just remember, technically, you don't own it. So if you were to heaven forbid you get disabled or get let go, or even if you just change jobs or retire, a lot of the times they'll tell you can take it. They just never mention to you that the price skyrockets when you're off that group rate. And everybody's company is different. I just advise you to read the policy and read those fine terms. You know what I mean?
Right. And something that a lot of people don't realize too, like when you do have, the group policies for life insurance, a lot of people don't realize that, hey, when you leave that job, in some cases, you can take it with you. And I know for me, that was something that I was blessed to be able to do. When I left my 9 to 5, I was able to, take my group policy and transfer it to me personally without it really changing in price, and even though that's not always the case, it's something that, as a person that's maybe looking to transition, it's a good question to be able to ask, as you said just a minute ago. So that's good. That's good information. And so when it comes to the term life versus a whole life policy, what is, so when it comes to the what would make someone choose one versus the other? What's the importance of, should someone get one term policy, or one whole life, or should they have one of each? Like, what is your recommendation normally when it comes to, life insurance and things like that?
That's a really good question. And it's one of those that I would have to answer the same way I answered a minute ago, as far as there's a lot of different ways you can go about it. For somebody that's younger, I'm definitely going to get a term policy on them. Like Antonio, I don't have children. I'm not married. I got some little sisters that haven't been to school yet, college wise. So if I die, they get 100. Yeah, I'm not. Yeah, they get over 100 grand. Their school's paid for, and my brothers, they get to pay off some of their debt. My debt's paid off, the whole nine. It just depends on what they have. If somebody's got a massive amount of debt, probably going to go term. If they've got, and they're young, and it all depends on what you can qualify for, because all of this stuff is based off your age and health. I'll tell you this, a lot of folks think that they can only get it with going to the doctor and getting a medical exam. That's just not the case anymore. I've been writing insurance policies that take about 10 minutes to apply for, instant approval.
No medical or anything.
No medical, they just have some questions.
Gotcha.
Questions, they look at your prescription history and you got to sign a HIPAA form and all that jazz, but it's a 10-minute application, and at the end, you throw in your account or your credit card or whatever the case may be, whichever company we go with, and then you're approved on the spot. Down the next day, you get a check. It's not that painful process that so many people thought it was, but I think the main thing is that you have to have a plan around this stuff. When it comes to insurance, you don't want to have an insurance policy. You want to have an insurance plan. Have a plan. You can replace a policy. You can't replace a plan.
That's good.
What's your plan on this? That's what it comes down to. And I think whenever I remember sitting in your home, and I was like, man, this guy's got his stuff together. This is fun. This is what it's supposed to look like here. All my other people take notes, but that's what I would say there. I mean, it just depends on what you qualify for. If somebody's a little bit older and they don't have children, and by older, I would say in retirement age, maybe they don't have any debt. Maybe they just want to get enough to put them in the ground. Well, I helped a man with his funeral expenses earlier today, and that was about $10,500, $11,500, something like that, for a standalone. And everybody knows about inflation, so it ain't going nothing but up.
Right.
But somebody that's younger, children, you got to have some on children as well. And I'm gonna talk about that a little bit later, but those children's policies, those fire me up, man. I like those things.
Awesome. That's good, man. And you mentioned, when you were at our house, and we were working together a few years ago. One thing that and I believe you shared this when we met, because I think I asked you something similar to what I just asked you. And a piece that you mentioned, or that I've heard before, is it's always good to have, especially if you're married with debt, things like that, having that term policy in place to cover those those prime years where the debt is there and the debt may be high. Having a term policy there just in case, something happens, hey, you can pay that debt off. And then having a whole life policy that then takes care of your burial. Um, that for me, when I think about life insurance, that's kind of how I think about it. Like having that, having both, having a whole life that's there forever, a lower amount that, is enough to put you in the ground and maybe buy kids some ice cream or something. But then having that term life to where, hey, if something happens, your whole life's covering you getting in the ground, and then your term life policy is covering, the debt and the things that could fall on your family members once you're dead and gone, or giving them enough money to be able to live a few months or a few years without you being here. And so when I think about, term versus life, I always say, hey, let's get both of them and work them together. As you said, put it together in a plan, an insurance plan, so that we can make smart moves.
Exactly.
That's good stuff. And so I heard you mention being qualified, and it depends on what you can be, what amount you're qualified for. Is there like a minimum or maximum age that someone can become insured?
No, the maximum age for life insurance is 85. My memory serves correct. You can get some cancer policies, or some health products there, that like critical illness, chronic illness, not critical, yeah, critical, terminal, stuff like that, between 85 and 90. But for the most part, you're looking from the time that somebody's born to 85, and I'll touch on those kids policies once we go over some of the cash building, the accumulation factor of it. But I think you got to be insured for all ages, because it's up to the big man as far as tomorrow. That's not up to us,
Right.
So you got to have at least a bare minimum to put you in the ground. Even a cremation is going to be every bit of $2,500 to $3,000, and it's hot enough outside. I ain't trying to. That's just me.
Right. So, when it comes to, when it comes to the cash accumulation and, the other types of policies, can you dig a little deeper into that? Like, because I hear people all the time talk about, turning their, becoming their own bank, and, using insurance for retirement and things like that. When it comes to those things, like what's that all about?
Okay, we're gonna break this down a little bit. So with term, and I'm gonna roll this over to Jack here in a second, but there's different types of there, you can use it in different ways. So with some of the term products, we have what we call the return of premium. I know we spoke about that, where it's great. Whether something terrible happens, here's a whole lot of money, and if nothing happens, hey, here's all your money back. It doesn't grow. It's just designed to give you all of your premiums back. Some companies will give you 75%, some of them will give you all of it. some of them help you grow your money, right? That's what we're gonna talk about now. And Jackson, I know you've helped a couple families with some, some universal life, some index universal life, some IULs for retirement. You helped your fiance there, with one not too long ago. Tell us about that, Jack.
Yeah, so she's currently a travel nurse right now, and she's making pretty good money. 24 years old, and was wanting to set herself up for retirement. So I went to Luke, and this was when I first got into the business. I went to Luke and I was like, hey, like, what can we do? And it said, called the company up, went through an illustration, and she was going to pay a certain amount of money for until she turned 65, and then she was going to have over $100,000 a year to live off of after age 65. Right, so that's one of the ways that we can set up retirement. Also, those are whole life plans, right? They cover you until you're 100, or is it 120, Luke? It's one of those two. They mature it.
Yeah, it's technically not called a whole life. It's technically called the index universal life, but it lasts forever. So
it lasts forever.
There is a death benefit, so you might as well call it whole life.
Yeah, exactly. But the main thing with those index universal life is accumulating what they call cash value inside the policy. So I've got an appointment tomorrow night with a family, and they're wanting to put a certain amount of money in to accumulate their cash value for their retirement, because what they've realized is that the 401ks are not as set in stone as they used to be, right? I know a bunch of people that have lost a ton of money in their 401ks. So now they're trying to take factors into their own hands and try to set themselves up to be better off than what they're seeing their parents look like right now, right? So I ran an illustration for them earlier today, and they'll pay. One of them's 36, one of them's 29. They're going to pay a certain amount of money, and then they'll have about, depending on what the market does, between 60,000 and 80,000 to live off of each year until they pass away. So that's just some of the ways that you can use, a life insurance product to benefit from it, in order to, before you pass away, benefit from it before you pass away. And you can pull on that money before you retire as well. I want to make sure I touch on that. My dad actually took out an IUL product whenever he first got married, and ended up paying for a $30,000 building behind the house with his life insurance, right? So you can kind of use that money ever how you want to. It's your money, and it's paid with after-tax dollars, so it's non-taxable. Okay, so and I'll put that back on over there to Luke too, but that's not all I have.
Yeah, that's good. That's good, Jack. And I personally love the index universal lives. They're one of my favorite products. And I'll be honest with you, Antonio, I don't know all the stuff about these things. When it comes to if I'm going to set somebody up with an IUL, as we call them, for short, I'm not going to just sit there and write it and trust my gut. I'm going to call the insurance company 8 times, and I'm going to call about 4 different professionals that I trust. We've got an entire team of that at Symmetry, or Quility, whichever one you want to call us now. We're not doing this stuff alone. It's not like we're a bunch of really smart insurance gurus here. We know some stuff really, really well. And what we don't know, we have professionals and like people that have done it for 10, 15 years alone for it. So we're just
Yeah.
giving you kind of the ins and the outs. But to touch on some of the things that Jackson was talking about, it's designed, it's life insurance because it has a death benefit, but you pay more for it because it develops a cash value as well, right? So I showed a guy not long ago, he was already paying $1,000 a month into his retirement. He was 25 years old, and the company that he already had an IUL, with the company I represent. He already had it before I even sat with him. I was like, man, you don't need any more life insurance. You're good. Like your death benefit already is over $1 million. Like, I think your family would be fine with that. Don't you? And he was like, yeah. And I was like, well, let me see if I can get more growth for you. And he was going to retire off about 150,000 a year off of that, based off of, the last 10, 15 years, with what the markets have done. And we were able to show him how to retire off of about 386,000 a year, just from putting $1,000 in from the time he was 25. Is that guaranteed? No, but you are guaranteed not to lose any money. If the market collapsed tomorrow, I know a whole lot of people that ain't losing a dime, and I know a whole lot of people that would be, a little sketched out, like a little 2008, 2009 situation. And you can also do stuff with people that already have 401ks. I mean, my one person that I'm, desperately trying to get away from his company is my dad. As far as their 401ks go, nothing wrong with a 401k. I'm not saying I'm a professional on those. I just know that people lose. I just know he lost, a good bit of money. He's gotten it back now,
Right.
but at one point he had lost it.
Yeah. And I've seen exactly what you're talking about. Like, I've seen individuals have, $300,000 today, and then the economy takes a hit, and that 300 turned into 50,000. And you're like, whoa, what happened there? And so in a situation where you have an opportunity to, fund something that is gonna be, it's gonna be definite, like, why not do that? Why not add cash to a life insurance policy that you can then later pull from as you need it, and then pay yourself back the money, with interest, technically.
That's the caveat. That's the banking part of it. I'm gonna touch on that at the end.
Okay.
Yeah.
Okay.
We're gonna dive into that. That's some good stuff.
Awesome.
Next thing I would like to talk about, though, is the children's policies. Personally, I love these. I help a lot of families with them. You can do a guaranteed insurability policy that might cost you a couple bucks a month. This is going to be your basic, for a kid, because we're not really worried about necessarily if the child, were to pass. We don't want to talk about doom and gloom, but we do know that things happen with health. When I moved to Greenville, I started at a gym over here, and I worked out with the same guy for 3 years straight, just about every day. You know, made quick friends with him. The only times that I didn't work out with him was last year for about 2 months straight, where he was battling chemo as a 24-year-old. You know, got a bit of cancer. He's fine now. He's one of the healthiest guys I've ever seen, but didn't have life insurance. You know, but he didn't die, right? Yeah, but now he can't buy life insurance. His insurability's gone. You know, he could get some policies, but it's not going to be a whole lot of good. You see what I'm saying? It's not going to be nearly what he could have had, because I help a lot of families with the guaranteed insurability side of things, where a child might be getting a 10 or 25,000 or $50,000, you know, whole life policy as a child. They've, you know, they can always go up in that coverage over time without having to prove insurability. You know, the Mutual of Omaha has a great one of those. And then I love a policy with Foresters that we have called Advantage Plus, where kids can, I mean, you can basically set up a college fund for a child from birth. You know, put maybe $100 in it, maybe 200, maybe 50, whatever you really can for that child. And then all of a sudden they want to buy a vehicle when they're 17, 18, you've got a cash value there, you know, and it's a lot more than you put in. It's a good bit more than you put in, you know. Or maybe you want to help your child with their first home purchase. You just thought about it when they were 2 years old instead of when they were 25 or 26 or 30, whenever they decide to buy their first home. Now you got a big down payment, or depends on how much you put into it. You could have a home that's paid for, but there's options there. You see what I'm saying? There's options there.
Yeah, that's
I
good.
love setting a child up. I love it.
That's good. And then when they start with the child policy, that automatically makes them insurable to be able to increase as they get older and things like that too, right?
Exactly. As long as you set it up right, yeah.
Wow. That's
Yeah.
good stuff.
Yeah, I mean, my buddy's married, like he's married and he's wanting to have kids one day, you know, and now he can't get that big term amount because insurance companies aren't fond of cancer, because cancer usually comes from people that have cancer in their past. You know,
Right.
I don't make the rules, I just have to follow them, but it's the fact of the matter. You know, and I could have offered this to him. This is why we're on here now, is because I didn't inform him about this the first 2.5 years I worked out with him. It broke my heart when I was on the treadmill, about fell off, you know, when he told me that. He's like, man, I got cancer. I was like, oh my God, dude, why didn't I tell you? You know, I could have written him a policy, Antonio, where he would have got paid $100,000 just by diagnosis. And it would have
Wow.
cost about $50 a month.
Wow.
You know, just by diagnosis, a check for $100,000. You know, I could have done that, and I messed up, right? So I'm not doing that anymore.
So telling everybody about it.
Got to. Got to.
Wow. And what type of policy is that called?
That's just a cancer policy or a critical illness policy. I read a lot of Critical Advantage with Mutual of Omaha. Great company. Love them.
Awesome. And so when it comes to those critical illness policies and things like that, so pretty much any type of critical illness you can get insured for that, as long as you're not I guess, sick when you get it?
It just depends. You know, they all have their stipulations. They have a whole list. I just don't know the list off the top of my head. I just know that
Okay.
cancer, stroke, heart attack are the big ones. You know, it's of the three of us here on the Zoom now that I can see, you know, two of the three of us are either going to have cancer, heart attack, or stroke, statistically speaking. Right. I'll take one of them, but where's the other one fall? I tell families that all the time. You know, I don't talk a whole lot of math when I'm in somebody's home or on a conversation with them, but I can't fight against statistics, you know, and I just want people to understand that that stuff is expensive. It is expensive. You know, if money is tight right now, imagine if you just had one income. Right. That's why people don't want to talk to insurance guys, because they ask the hard questions. I don't
Yeah.
like to, but I have to.
That's good stuff, and that's true. And sometimes, one thing that I go by in my coaching and all that stuff is, you can't fix what you don't face. And so, sometimes those hard questions are necessary, to be able to set yourself up for, a better future, or set your kids up for a better future. And so, I'm grateful for individuals like you that, don't mind asking those hard questions so that we can make sure things are, set up the way they need to be, and be able to build from there.
I appreciate that, man. And you can't fix what you don't face. I like that.
You can't fix what you don't face.
I'll,
If you're
go ahead. Go ahead.
if you're running from it, if you're, afraid of stepping in there and asking or answering those tough questions, I mean, it ends up biting you in the foot later on.
Mm-hmm.
And so go ahead and face it so you can fix it, and build from there.
That's good, man. That's good. And I tell a lot of folks whenever they, tell me this is uncomfortable. I'm like, yeah, I'd rather do a biopsy than an autopsy though,
Oh man.
That's the reality, let's
Yeah.
fix this problem before it becomes a problem. We can sacrifice a whole lot now, like a little tiny bit now, or we can sacrifice a whole lot later. And generally, delayed sacrifice is it's a lot more painful.
Right.
We just want to make sure that everything's going to be all right. And it's not that we're trying to preach doom and gloom. It's just that I think we've all seen it in our lives somewhere where somebody's lost just about everything. I remember there's a guy on our team named J.R. Fields, and he won't mind me sharing this story because he shares it a good bit with us. But I mean, he was in the door knocking business, spinal expense business, for 25 years, knocking on doors all up and down the East Coast. And he knocked on this lady's door, helped her out with a policy, got a referral, which was her son, right? And she had two grandbabies, right? I think they were under 10, and her son's wife had passed away in a car accident the month before, right? Tragic, no life insurance, and that was going to be really tough on him as now a single parent with two under 10. That's expensive life as it is.
Oh yeah.
On top of all the grief, Lord have mercy. Well, yeah, he set an appointment with the guy, and the guy didn't show, had something come up, and didn't want to do it, and ended up 2 or 3 appointments later, JR couldn't get back on the phone with him, and that guy passed away the exact same way, car accident. Less than 3 months, both of them gone, and now single 60 or 70-year-old woman's raising 2 youngins with no money, just Social
Wow.
Security. That's just the reality. So I don't want anybody to think that I'm coming off harsh. It's just like, I'm very passionate about this stuff, and like, this stuff is important. This is what's kept me. Whenever you can, it might hurt now, but just I've never had somebody turn me away at a funeral with a check. Even if it was just
Yeah.
a small one.
Yeah, yeah, that's good, man. That's good. And so you mentioned you mentioned earlier, and this is really one of my final things, is you mentioned earlier that there are, what did you call it? Or have we talked through that? You mentioned the banking element of
Banking element.
insurance.
Yeah, I can touch on that. Now, this is not my forte by any means, but I've understood it enough to get some clients out of it via a guy named Keith Fonseca, really good buddy of mine. He teaches our entire company of 5,000 or 6,000 agents how to do this, how to explain it, how to understand it. I don't trust myself enough to write it on anybody that you have, but I refer them all to DJ. We call him DJ Debt Free because he understands it that well. He lives it, he sleeps it,
Wow.
he breathes it. But it's basically, if you look at if you look at who owns the most life insurance in the United States, I think it's Bank of America. Nobody would have expected that, right? Bank of America,
Right.
BB&T, which I think is now Truist. I don't know, but it's a bank, right? It's a bank, and they have all of a good portion of their assets there, because with some of these policies, and it's participating whole life. There's a whole lot of different that goes into it, but basically a company that gives you dividends. We like to use a lot of Forsters for ours personally, but what essentially we're doing is we're overfunding a life insurance policy, because life insurance, you have 2 different buckets that you throw into. You throw into the death portion, and you throw into the cash value portion. So you have to have a death benefit associated with it. But at the end of the day, you're going to earn between 4 and 6% or something like that, because that's what the banks are earning off of your money, but yet in the savings account, they give you what, with some banks, like 0.25%,
Yeah.
man.
Yeah.
I earned a penny and a half last month. Yeah. And so just know that they're taking a big profit, and all we're doing is taking the bank out of the middle, because that's what they are, as a middleman.
Gotcha.
It's a genius idea for a bank, but now all of a sudden you can take loans from yourself, and guess what's not taxable? A loan, right? A death benefit's not taxable, a loan's not taxable, and what's that thing about a loan is, normally there's people out there wanting their money back, but you're borrowing from yourself.
Right.
So if you were to pass away, then it just comes out of the death benefit. So it's, you're borrowing from yourself to pay yourself, and your cash value while you've borrowed from it still grows. It is an incredible thing. I just know this is that I helped a man get completely debt free. He had a $400,000 mortgage. He had I'd say about $75,000 of debt outside of that. Right. I think he's about to get approved for this, because you do have to get, this is a more strenuous underwriting because it's a more exotic plan per se. But a total of about, let's just say about $450,000 of debt. It was a 30-year mortgage, by the way, and we showed him how to pay that off in 11 years, all of it.